Thank you everyone for joining this investor presentation on the Biotech Growth Trust. By way of introduction, my name is Jeff Hsu. I'm a general partner at OrbiMed. I've been with the firm for over 20 years covering the biotech sector, and I've been a portfolio manager of the Biotech Growth Trust since May of 2005. Joining me on this call is my colleague, Josh Gollum. He is a partner in the public equity team at OrbiMed. He also has over 20 years of experience covering the biotech sector, and last year he was made a co-portfolio manager of this fund. For those of you unfamiliar with OrbiMed, just to give you an update on our firm, we are a global healthcare dedicated investment firm with over 25 years of experience investing solely in the healthcare space. We currently have $17 billion of assets under management, and that is distributed across a number of business lines that are shown in the pie chart on the left-hand side of this slide. You can see that the Biotech Growth Trust, as well as its sister trust, the Worldwide Healthcare Trust, represent a majority of our public equity business. We have 142 global employees. We made over 20 new hires over the course of 2023 and 2024, so we are continuing to expand our organization. And those professionals bring over 300 years of investment experience. 30 of my colleagues have either an MD or PhD degree, so we have a lot of in-house technical expertise, and we do think that is critical to investing in healthcare successfully. Let me now talk about performance of the Biotech Growth Trust, starting with a recap of last fiscal year's performance. So this is a graph showing fiscal 2024 performance for the Biotech Growth Trust. That encompasses the time period from March 31st, 2023 to March 31st, 2024. You can see that we had a strong year of performance with the Biotech Growth Trust NAV up 26.5% versus our benchmark index, the NASDAQ Biotech Index in gray, up only 5%. So significant outperformance last fiscal year. And a lot of that was really driven by a nascent recovery in small and mid-cap biotech in particular. So here's a graph that shows that. If you look at the lower left-hand corner of this slide, you can see we have a table here where we've taken the portfolio constituents of the Biotech Growth Trust as of March 31st, 2023, and classified them into three major market cap categories. So large cap stocks with market caps in excess of $10 billion, mid cap stocks with market caps between $2 and $10 billion, and small cap stocks with market caps below $2 billion. And we've juxtaposed that market cap distribution versus that of our benchmark index, the NASDAQ Biotech Index. And you can see that entering last fiscal year, the way we were positioned was significantly underweight large cap stocks and significantly overweight small cap stocks. Now, if one then plots the average stock price performance of the index constituents in each of these market cap categories, you can see that small cap stocks in gray and mid cap stocks in green significantly outperformed large cap stocks over the course of the fiscal year. And given how we were positioned, that was a nice tailwind to our performance. We ended the fiscal year with much the very same positioning, so underweight large caps, overweight small caps, and mid caps. Now, I do want to frame that performance in a broader historical context. So what we've done here is taken that same graph looking at average stock performance in each of these market cap categories, but just over a longer time period. So here, this graph actually starts at March 31st, 2021. And you can see that since March 31st, 2021 through September 30th, 2024, small cap biotech and mid cap biotech in gray and green respectively have significantly underperformed large cap biotech. The fiscal year that I just showed you is highlighted by this gray box in the middle of this slide. So we do see some nascent recovery of small and mid cap performance versus its large cap peers over the course of the fiscal year. But the point of this slide, what I really want to emphasize here, is that there's much more to go. We do fully expect this performance gap between small and mid cap biotech and large cap biotech to completely close over the next several months. Actually, the gap has widened a little bit post the fiscal year end, but we do expect that to ultimately close. So there is quite a bit of upside in our view in the small and mid-cap areas of the biotech universe, and that is exactly how we are positioned. So as of September 30th, 2024, again, significantly underweight large cap stocks and overweight mid-cap and small cap stocks in the portfolio. So here's just an update of the fiscal year-to-date performance. How are we doing during the current fiscal year? And this covers the period from March 31st, 2024 to September 30th, 2024. You can see that the Biotech Growth Trust NAV is up 2.7% across this 6-month period, which is above the performance of the NASDAQ Biotech Index, our benchmark index, which was up 1.4%. And we will be issuing our semi-annual report next month, so you can have more detail on what contributed to that performance. Now, one thing I'd really like to emphasize and highlight is the fact that the underperformance that we saw in small and mid-cap biotech was actually not anything particular to biotech. This is a phenomenon that we saw across the market. And this graph illustrates that point. So if you look at the Russell 2000, which is a broad-based market-wide small and mid-cap index, versus the Russell 1000, which is a broad-based large-cap index, and you compare the performance of those two indexes relative to each other since March 31st, 2021, you can see that the Russell 2000 actually has underperformed the Russell 1000 by about 40 percentage points. We don't think this is a sustainable state of affairs. We do think there is a significant recovery and reversion trade in the offing for small and mid-cap stocks generally. And so if that does occur and this small and mid-cap segment recovers, the portfolio is very well positioned to capture that recovery. Another way to look at biotech performance versus the general market is to plot the XBI versus the S&P 500. The XBI is actually an ETF that many investors use as a proxy for small and mid-cap biotech performance. And what we've plotted here since 2006 is actually the relative performance of the XBI versus the S&P 500. And you can see that for most of the past 15 years, biotech has actually outperformed the broader market. So it's been a good place to invest. But there are some transient periods where the XBI does underperform the S&P 500, and that is shown by the red circles on this graph. After each of those periods of underperformance, one generally sees a period of outperformance. So the XBI resumes its outperformance versus the S&P 500. That is shown by the green arrows on this graph. And so on the very right-hand side of this slide, you can see how unusual and anomalous this latest drawdown has been. This has been the longest drawdown of the XBI versus the S&P 500 that we've ever seen, the largest absolute drawdown of the XBI, the largest relative drawdown of the XBI versus the S&P 500. So a very, very severe drawdown that really is unprecedented. But importantly, we do think that history will repeat itself. In other words, we do think there will be a period of nice outperformance of small and mid-cap biotech versus the S&P 500 in the months ahead. You already see that the drawdown has stabilized a little bit. So we think that the relative performance drawdown has basically played out. And now we are just eagerly awaiting that period of outperformance. And one of the reasons why we have such conviction that a recovery will happen is because this latest drawdown has been so severe that it's really driven absolute valuations for biotech to unprecedented lows. And one way to look at valuation of these unprofitable biotech companies is simply to take the median ratio of the market caps of these companies versus the net cash that these companies have on their balance sheet. And we've done that in this graph here since 2001. You can see that this latest drawdown has really driven valuations on this metric to record lows. We're actually trading at levels below the dot-com bust, below the great financial crisis, below Hillary Clinton's election campaign in 2016, where she talked about drug pricing. So really, really unprecedented lows that we've never really seen before. Another way to look at that is to plot the percent of biotech companies trading at market caps below the net cash on the balance sheet. We've done that on the left-hand side of this slide. And at the lows of the XBI, over 25% of the industry actually was trading at market caps below the net cash on their balance sheet, negative enterprise values. We think that is completely unjustified given the industry fundamentals. And you can see in historical context how unusual and anomalous this is. We've never seen this in at least the past 20 years. That translates on the right-hand side in terms of the number of biotech companies trading below the net cash on the balance sheet. Again, at the lows, over 150 biotech companies trading below the net cash on their balance sheet. So encouragingly, though, we do see Some hints of normalization of valuation on the very right-hand side, but there is a far way to go in terms of getting these ratios back to the historical averages, and ultimately, we do think that is going to occur. So one of the principal reasons why we've seen such a dramatic drawdown in small and mid-cap biotech in particular over the past 2 to 3 years is because we've seen some fairly aggressive interest rate hikes by the Fed over the course of 2022 and into 2023. Here is a graph showing the 10-year US government yield in black since 2005. And we've overlaid on top of that the year-over-year inflation in the United States as captured by the CPI in light green. And you can see at the bottom, we've plotted the Fed fund rate increases and decreases that have happened since 2005. And of course, as you all know, the Fed did take some very aggressive interest rate increases over the course of 2022 into 2023 in order to control inflation in the United States. That policy has largely been successful. You can see here, inflation peaked in the US in mid-2022 and has fallen sharply in light of those interest rate increases in the ensuing months. We are now much closer to the Fed's stated target of a 2% inflation rate per annum in the United States. And very importantly, the Fed has basically telegraphed that they're done raising rates and they're now looking to cut rates. And last month, we had the first interest rate cut by the Fed. They cut the Fed funds rate by 50 basis points last month in September. We think that is going to kickstart a number of further interest rate cuts over the balance of 2024 and into 2025. What that means is that the 10-year yield, which has been rising since 2021, has leveled off here, and we think is actually going to start coming down over the next couple of years. So the interest rate picture that has been really a significant headwind for biotech performance over the past few years is hopefully going to become a tailwind for biotech sector performance. And I think that interest rate pivot is really, really important to catalyze that re-rating. So here's a graph showing the Biotech Growth Trust performance since our inception as manager since May of 2005. You can see that the Biotech Growth Trust NAV has outperformed our benchmark index, the Nasdaq Biotech Index, since inception. We do see here, though, a dramatic drawdown in performance, as I've highlighted just now in the previous slides, that we are still in the midst of recovering from, but we are confident that we will be able to recover the same level of outperformance that we saw historically in 2020 in the fund over the next couple of years. And the reason for that confidence is the valuation contraction that we've seen in the biotech sector, in our view, is very disconnected from what's happening fundamentally in the industry. The fundamentals of the industry are very strong right now. Innovation is very robust. And to illustrate that, we have a slide here showing just some key breakthroughs in biotech in just the last 18 months. And I'll highlight just a couple of these examples so you get a flavor of what's going on in the biotech sector right now in terms of innovation. If you look at the fifth entry from the top, Avidity Biosciences, they have a small interfering RNA bound to a monoclonal antibody. This is a completely novel drug development modality, never been tried before, but their drug candidate, Delbrax, recently showed in a phase 1/2 trial muscle function improvement for patients with a rare form of muscular dystrophy. So really showed proof of concept for this very novel cutting edge drug development technology. Another one I'd like to highlight is CRISPR Therapeutics and Vertex, the second one from the bottom. They recently got approval for a therapy called Casgevy. This is the first ever gene editing therapy approved in the world. It is indicated for sickle cell disease and beta thalassemia, another groundbreaking result in terms of the science that is going on right now in the sector. And that innovative science is really translating into marketed products. So here's a slide showing significant FDA biotech approvals in 2024. And I just point out the fact that on the right-hand side of this slide, in the last column here, we have the word first in bold for every single entry on this page. And that is because every single drug approval on this page is groundbreaking in some way. It's either because it's a completely novel mechanism of action that's never been approved before, or addresses a significant unmet medical need. So we're seeing really groundbreaking innovation occurring in the sector, and that is translating into some important products that are providing clinical benefit for patients. I just wanted to highlight a couple of therapeutic areas, again, so you get a flavor of what's going on innovation-wise in the sector right now. The first one I'd like to highlight is oncology. Cancer does remain the #1 therapeutic area for biotech drug development, given the significant unmet medical need in this area. And on the slide, we've just presented a number of innovative drug development technologies that are being applied to develop cancer therapeutics. So we have cellular therapies, antibody drug conjugates, bispecific antibodies, targeted therapies, radiopharmaceuticals, and cancer vaccines. And importantly, every single one of the approaches on this slide has already demonstrated positive proof of concept in clinical trials in humans. So they've already shown benefit in human clinical trials for cancer patients. So these multiple innovative approaches are generating clinical benefit across tumor types, and that, of course, is going to give physicians more treatment options to extend the lives of cancer patients. So it's a very exciting time of innovation in the cancer field. The second therapeutic area I'd like to highlight is obesity. Obviously, this has gotten a lot of media attention of late, but we have a number of biotech companies racing to develop the next wave of obesity therapies in this potentially $200+ billion market. So this is a substantial growing market. We currently have 2 leaders in that market, Eli Lilly and Novo Nordisk, with their GLP-1 agonists. Those first-generation weight loss agents are capable of delivering 12 to 18% weight loss over the course of 1 year. Some of the second-generation candidates in development right now have shown over 25% weight loss in people in clinical trials over the course of 1 year. And those 2 leaders are actively conducting clinical trials to not only show that these agents can lower your weight, but can also deliver a lot of ancillary clinical benefits for patients. So we now have data that shows that these weight loss agents also can reduce your risk of heart attack, reduce your risk of stroke, can prevent the onset of kidney disease, can improve the symptoms of conditions like sleep apnea. Having said all of that, we do think there is still room for improvement in this therapeutic area. Right now, the first-generation weight loss agents require a weekly subcutaneous injection. So there are a number of companies now are working on oral weight loss agents that would be a convenience for patients. Some of them are working on injectables that can be dosed less frequently than once a week, maybe once every month or once even every quarter. There are a number of companies that are looking at novel mechanisms of action apart from GLP-1 that might have some benefits for patients. And it turns out that the GLP-1 agonists, while they're very, very effective, they do have some shortcomings. So they do elicit some gastrointestinal side effects, nausea, vomiting, diarrhea in some cases. And so there are a number of companies trying to develop weight loss agents that are more tolerable for patients. It also turns out that if you're on a GLP-1 agonist, you not only lose fat, but you also lose lean muscle mass. So there are a number of biotech companies developing companion therapeutics that you would take in conjunction with your GLP-1 agonist that would actually allow you to preserve your lean muscle mass so that you only lose fat with the GLP-1. So some very interesting science going on there. And so in the lower right-hand corner of this slide, we have a box that shows a number of biotech companies that are active in the obesity space. The Biotech Growth Trust portfolio does hold shares in a number of these companies. And so overall, our conclusion here really is that despite the fact that Lilly and Novo do have a compelling head start in this marketplace, we do think the market is large enough to support multiple players. So as a shareholder, as an investor in this particular fund, you do get exposure to a nice cross-section of the latest and greatest drug development technologies in biotech. We've listed a number of those technologies on this slide, along with a percent NAV exposure in the portfolio to each of those technologies. At the bottom, we've also shown a number of portfolio positions as of September 30th of companies that are working with each of these technologies. And so again, if you're interested in really tapping into the great innovation occurring in biotech, this portfolio definitely expresses that. Moving on to the regulatory environment, we have had a very constructive FDA regulatory environment over the past several years. Here's a graph showing the number of FDA new drug approvals since 2016. And you can see that actually last year, 2023, was a record year for FDA new drug approvals, 67 new drug approvals at the FDA. And this is consistent with the elevated rate of drug approvals that we've seen since 2017. So 2017 was the year in which President Trump first took office. He put together or installed an FDA commissioner named Scott Gottlieb that was frankly very proactive in terms of approving new drugs. So we have an FDA policy right now that is really flexible in terms of the endpoints that they're looking for in terms of approving new drugs. They've, in many cases, approved new drugs based upon less than perfect data sets. And they've shown great enthusiasm to approve new drugs for unmet medical needs. So we do expect this elevated constructive approval environment to persist over the next several years, regardless of who gets elected president in this upcoming election. Next, taking a look at the financing environment. The financing environment is improving. Here is a graph showing biotech IPOs and follow-on offerings in the public market since 2015. Each of these vertical bars represents funds raised in that particular quarter, where the blue portion of each bar represents IPO proceeds, and the light green portion of each bar represents follow-on financings. You can see that the number of IPOs has declined substantially since the heyday of 2020 and 2021. So a bit muted activity in 2022 and 2023, but encouragingly, we are seeing an uptick, slight uptick in IPO activity in 2024. In contrast to that, I think in terms of follow-on activity, if you look at the number of follow-on offerings shown by this solid green line, it's remained actually fairly robust, even despite this downturn that we've seen in valuations. So quality biotech companies with good assets that have shown proof of concept in human clinical trials, those companies have had no problems getting financing. And I think that's an important point to drive home. So there are plenty of investors who are interested in investing in these companies. A lot of those deals, frankly, have been oversubscribed. And so we think, generally speaking, the financing environment is pretty strong for biotech and should improve as valuations tick up over time. The Biotech Growth Trust has been participating selectively in IPOs and confidentially marketed follow-on offerings, and we will continue to do so as opportunities arise. Let me now turn to M&A activity in the biotech space. M&A has been a historical driver of returns in the biotech sector. Here is a graph showing announced public biotech M&A transactions since the first quarter of 2018. There is some natural variability from quarter to quarter in terms of M&A activity, but it's been pretty robust in terms of M&A activity over the past couple of years. We've seen a little bit of a fall off in the past couple of quarters. I attribute that to sort of a wait-and-see attitude that some companies may be taking in advance of the presidential election, but we do expect a pickup in the fourth quarter of 2024 into 2025. And the reason for that is if you look and listen to some of the recent comments by big pharma CEOs shown here on the lower left-hand corner of this slide, all of them to a T have talked about M&A and the importance of M&A in terms of their business strategy. And in fact, if you look at the lower right-hand corner of this slide, we've listed here just a number of biotech transactions that have been announced where the Biotech Growth Trust held the target at the time of acquisition announcement. So you as a shareholder of the Biotech Growth Trust do benefit directly from this M&A activity. One of the other reasons why we think M&A is going to accelerate over the coming months is because big pharma is now facing a patent cliff on a lot of their blockbuster drugs through the end of this decade. We estimate nearly $270 billion in branded sales are at risk of generic or biosimilar competition through 2030. We've shown that on the left-hand side graph on this slide. On the right-hand side, you can see a number of examples of those blockbuster drugs that are due to lose patent protection before the end of this decade. You know, Merck at the top with their blockbuster drug Keytruda, that single drug alone delivered $25 billion in sales for Merck in 2023, and yet is expected to lose exclusivity starting in 2028. So you can imagine that a lot of these big pharma players are aggressively looking for biotech companies to acquire in order to offset that upcoming revenue deficit. So we do expect M&A activity to remain quite robust in the coming months. The last theme I'd like to touch on is the 2024 US presidential election that is scheduled for November 5th, so coming up very soon. We've certainly seen a very unusual, frankly, and volatile summer in election year politics, with President Biden stepping down as the Democratic nominee and being replaced by Vice President Kamala Harris. Harris's appointment as the Democratic nominee has certainly improved the chances for the Democrats. Right now, if you look at the latest polls, the presidential race remains a very, very close call. But I would say overall, the election risk for biotech in particular, we think is actually very low. And we've outlined a number of scenarios that could occur as a result of the election in the lower right-hand corner of this slide. The only scenario that we think could conceivably be negative for the biotech sector is a Democratic sweep, meaning that the Democrats win the presidency and take control of both chambers of Congress. But we think the probability of that happening is actually quite low. We assign a very low probability of 5% that will happen. And that is because the recent polls indicate that the Republicans are highly likely to take control of the Senate at this upcoming election. So the chances of a Republican sweep are quite a bit higher, 35% we estimate. Again, these are just guesses based upon the latest polls. Republicans tend to, historically speaking, be very industry friendly. In fact, they may revoke some of the most egregious parts of the Inflation Reduction Act that was recently passed that called for Medicare price negotiations. But actually, the most likely scenario that we expect is some sort of divided government where no one single party controls the presidency and both chambers of Congress. And in that scenario, which we assign a probability of 60%, basically you just get a lot of gridlock where nothing extreme gets passed. And we think that would be a positive for the biotech sector. So overall, regardless of who wins the presidency, we do not foresee much election risk to the sector. And I would also note that healthcare has really not been a central campaign issue for either candidate. They've really been focused on immigration, the economy, inflation, et cetera. So just to sum up, what is our strategy for the balance of 2024 and outlook for 2025? Well, our strategy is really going to stay largely the same. We're going to continue to emphasize emerging biotech over large cap biotech in order to fully capture the sector rebound that we expect in small and mid cap biotech in particular. We're going to capitalize on compelling investment opportunities in companies that need to finance at low share prices. Gearing level, you should expect to generally stay between 5 and 10%. The unprecedented low valuation that we're seeing in emerging biotech does suggest significant upside from current levels. The performance drawdown of small and mid-cap biotech versus the S&P 500 has been the longest and most severe we have ever seen. That has meant that the percent of biotech companies with market caps below the net cash on their balance sheets is well above historical norms. We're trading at valuation levels now that are lower than that of the great financial crisis and the bursting of the dot-com bubble. And importantly, we have now seen a pivot in the interest rate picture. Interest rates now are anticipated to decline over the next several quarters rather than increase. And we think that's going to be a nice tailwind for a biotech re-rating. For those of you who are concerned about the risks of a recession in the United States, I would also point out the fact that biotech has historically outperformed other sectors of the economy during a recession. So one of the main principal points I'd like to make in this presentation is that the valuation contraction that we have seen in 2021 and afterwards is really disconnected from the fundamental innovation in the sector, which remains robust. M&A activity we do expect to accelerate given the lower valuations of biotech targets and the urgent need for new products by big pharma facing patent expirations on a lot of the blockbuster products. Political risk, we think, remains fairly low going into this election, as I just outlined. And so as a firm, OrbiMed does believe that this is an excellent time to invest in biotech innovation at unprecedented low valuations. So with that, thank you so much for your time, and we are happy to answer any questions you may have.
Thanks very much for that, Jeff. That was my most interesting presentation. If you'd like to ask a question, can I remind you to click the Q&A button, which you should see at the bottom of your screen, and you can just type in your question. Whilst we see whether any of the audience wishes to ask any questions, there's a couple that I can put to you. OrbiMed is quite heavily involved in private equity as well as the public markets. Does this trust invest in private companies at all, or is it only quoted companies that you invest in?
We do invest in private companies in the trust, though typically we are investing in what they call crossover rounds. So the last private round prior to an anticipated IPO. And so we have been active in the past in doing that. Recently, though, because the IPO market has not really opened up yet, we've kind of tamped down our activity in the private space. There's so many public companies, frankly, that are trading at bargain basement valuations, in our opinion. So there are plenty of good investment opportunities in the public space. But as the IPO markets open up again and become more active, we will start investing in privates again.
Right, that's answered the next question I was going to ask. Meantime, we have a question from Gary. Just on valuations relative to the GFC and the dot-com crash, have the recent numbers been adjusted for inflation?
The recent numbers been adjusted for inflation. So we did
What
not.
you showed in the presentation, in other words.
Yeah. So we haven't done an explicit adjustment for inflation. I think really in broad strokes, it's really a matter of where the market cap lies relative to the net cash on the balance sheet. Basically, if the company is trading at a market cap less than the net cash on the balance sheet, basically people are saying that this company is never going to become profitable, never become a positive net present value project. And we just think that's unjustified relative to what we see in terms of the fundamentals of those particular companies. There are some where it may be justified, where the asset just isn't very good, but there are plenty of companies that we do think have very promising technologies or assets where we just think the valuation is unjustified for what they have.
Thank you, Jeff. Now we have a question from Adrian. If one looks at the chart, 2021 appears to be an aberration, a spike. Before that, there's been a steady rise in your share price from 2014 to today. I guess Adrian's asking for any comments you may have on that statement.
So I guess you're looking at this graph, perhaps.
Yeah.
Yeah, so look, we I think had a pretty good track record going into 2020. And I'll be honest with you, the severity of this drawdown really caught us by surprise. In fact, if you look at the correlation of small and mid-cap biotech to interest rates prior to 2021, actually, there wasn't a very strong correlation. So while a lot of people say, okay, the rise in interest rates is what's caused this downturn, it's not something that one would necessarily have predicted in advance. But regardless, as I've hopefully emphasized in this presentation, we've really been driven to unprecedented lows. So this number or the share price or this NAV is really kind of at bargain basement lows in our view for the sector. We are starting to come out of that, but we think, as I mentioned in the presentation, there's quite a bit more of outperformance to go for the sector.
Yeah, fingers crossed. Talking about the sector, how would you distinguish your strategy from that of other biotech trusts? There are two I can think of, Bellevue Biotech and International Biotech. What's distinct about your strategy?
Yeah, so I think there are a few elements there. I think we have a larger global footprint than some of those other funds. So we can invest around the world, US, Europe, China. Again, I should mention that we actually have 3 research analysts based locally in China, in both our Hong Kong and Shanghai offices. And while China has been a very difficult geography to invest in, we are seeing recently a pickup in that market. And I would also emphasize the fact that innovation in China and biotech is actually quite strong. In fact, we have a number of Western companies that have recently in-licensed or outright acquired Chinese biotech assets. So number one, global footprint. Number two, I think our stature in the healthcare investing space means that we get great deal flow. So a lot of these companies will do what's called a wall cross offering, where they will selectively choose a handful of investors to confidentially look at an upcoming financing. Sometimes as part of that process, I actually share confidentially some data or results that the public markets do not know about yet. And we get access to that flow because of our stature in the industry. That's something, that's a look that not other funds may yet. We've put that, frankly, to good use in making some really, really stellar investments over the past couple of years. That also plays a part in our IPO allocation. So if there is a hot IPO, we actually have a very successful venture capital business. Every single company that goes public right now, we've seen as a private company because our venture capital team has taken a look at it. So in terms of getting allocation to IPOs, your relationship with the company matters a lot. Does the management team know you, et cetera? And so we've looked at them multiple times, met with them multiple times. We are more likely to get a good allocation in the fund on a very popular oversubscribed IPO. I would think, say in general, just building on top of that, we do have a fairly large team. So not only on the public side, I have 5 dedicated biotech analysts working underneath me and Josh. The venture capital team is a whole separate team of multiple analysts. And there is quite a bit of synergy between the different business lines. So we do encourage the sharing of information across business lines. And I think that's another advantage that we may have versus our peers.
I think it's true to say that OrbiMed is completely focused on the healthcare sector, and the complete OrbiMed team is considerably larger than most of the other trusts. So as you say, if you count in the synergies of your venture capital people and the other funds that you run, it's a pretty large team. Is that correct?
That's right. Yes.
Yeah. Thank you. Well, we don't seem to have any other questions at the moment. If anyone would like to ask any, this is a great time to do it, particularly while we've got the experts here. Do take advantage of their presence. But if not, then I'll just say thank you very much. It was a very, very interesting presentation, and thanks for answering the questions that we had. And best of luck going forward with your fund.
Great. Thank you, Mark. Thank you, everyone, for.
Thanks, Jeff. Thanks, Josh. Nice to see you.
Take care.
Bye for now.